Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly Australian housing and economy update with our friend Martin North, and you're coming to us live from home today, is that right, Martin?
Yes, unfortunately the NBN's down, so my studio is not able to talk to the 4G. So we're on 4G off my iPad, but hopefully it'll be pretty good.
You sound good to me, Martin, and more importantly, you're not looking skinny for everyone at home, which is fantastic. So,
Indeed.
I mean, how much has changed in a month? We think last month we came on and said, hasn't the world changed? But it's just incredible. Even the past 24 hours, there's been so much news, Martin.
Yeah, well, the rate of change of information is just dramatic. And of course, everybody's throwing kitchen sinks and, washing machines and coal kitchens at the problem to try and actually deal with the crisis and its fallout. And so it's really tough now to try and keep a track on everything that's going on. But we'll perhaps cover some of the critical points. And I'm sure there will be more news even tomorrow and next few days. It's not stopping.
Yeah, and for someone like myself who tries to be pretty balanced, and I know both of us get those comments as saying, you guys are fear-mongering and the stock market's never going to crash, but it really is happening at a faster pace than even I could have predicted. I think some of these announcements are not getting priced in the way they should yet. I think, gold's jumped a bit higher, but man, oh man, if they want to keep printing these trillions of dollars, something has got to give. And I actually think we're heading to a place where they're trying to keep up markets, even when we could be in a depression. So for people at home who are thinking a lot of this doesn't make sense, why are stocks going up and whatnot, just be aware that, there is a lot happening. And even for someone that's been looking at markets for years and years, this is the most bizarre time ever.
Well, we've never seen in our lifetime a global depression emerging before our eyes, created not just from financial mismanagement, but essentially because of a health issue, right? And, stocks are priced off future expectations of earnings. And I have no idea how anybody can make any expectations about future expectations of earnings based on what's going on, because, you don't know whether this is going to go on for weeks or months or years, So we are in absolutely uncharted territory. What we do know is that the central banks around the world are doing everything they can to support the financial system and financial stability. And, that's one of the reasons why the markets are relatively positive. But the real economy and real households and real people are being hit really, really hard at the moment. And I don't think that has been priced in yet, really, truly in the market. So, I don't think that we're seeing a significant and sustained bounce. We're going to see ups and downs. That's a typical bear market. And quite often in a bear market, you'll see significant recoveries and then further falls. And I think we're going to see further falls ahead.
Such a good point, Martin. And if I was in charge, you've got to make sure that people are looked after. The financial markets and a number on a screen can be fixed at any stage. So while we're trying to tinker and announce new stimuluses every 2 days, when we haven't got the unemployment situation sorted and food lines and the health situation, we're seeing shortages. It just does my head in. But anyway.
Yeah, the Centrelink queues and those shots were, for me, the most powerful scenes in Australia about what's happening. We've got real people out of work and quickly out of work. And, as we'll get into the data, that's really where the focus needs to be. And unfortunately, even the stimulus packages in Australia are indirectly supporting, but they're going via businesses. And I think that's probably a mistake as well.
Yeah, okay. Well, let's get into these slides. As always, thanks for preparing these, Martin. And first up, we've got unemployment rate rising. And Roy Morgan brought out their research, and this was something that I couldn't believe when the economists were saying, we might hit 10% unemployment by the end of June. And I think I tweeted and spoke about it in a few videos saying, we're going to be at 10% by the end of next week, which is this week here. Haven't they seen those lines that you just spoke about at Centrelink?
Well, you wonder. So the Roy Morgan data is always a different basis to the ABS data. So that's the first thing to say.
Yes.
But nevertheless, the huge spike, it's the earliest indication we've got from relatively official data.
Yeah.
And it's massive. There's about 1.2 million jobs probably lost now. That's massive. And it mirrors the US, which brought their numbers out. They've got something like 15 million now out of work. 15 million. Yeah. I mean, these are huge percentages. These are percentages which are now above the 1930s. And bearing in mind, of course, that in Australia, we've got this support mechanism to keep people attached to their businesses. So the official number may be lower than the quoted number. Westpac was saying they thought it would be 17% a couple of weeks ago. They're now saying it could be around 10%. I think that probably could be an understatement based on what I'm seeing. And certainly the Roy Morgan data, to my mind, is giving a more realistic view of what's really going on.
Yeah, for sure. Sorry, I should have highlighted the Roy Morgan data isn't the official data, but I do think when they're coming out with 17%, I agree. I think we see the official number somewhere near 10%. And maybe it's lower, as you say, but more and more we're hearing stories of people that fall through the cracks and don't quite fit onto this JobKeeper program, mainly because of businesses that don't have strong enough balance sheets to just keep paying their 10, 20 or 100 staff, even if they know that money is coming down the line.
Yeah, that's right. So many people are basically having to pay out of reserves. Many businesses have no reserves. My SME surveys are showing that. We've already seen many businesses close. And the fact is we know that people with less structured work, part-time people, gig people aren't going to be picked up with these, more than 1 million of those. We know that there are sort of small businesses, single traders who are just now out of work. So there's probably 1 to 2 million likely to go that direction. And so whilst this helps, the government program helps, it's not going to be sufficient, I think, to insulate most of the economy from the impacts of a high unemployment.
Yes. We've had this flattening of the curve in Australia, which is fantastic, and it probably happened sooner than I thought. In terms of the health reasons why that is, maybe we did get a little bit luckier with our warmer climate. But either way, it is good news, but we have to be aware that China and South Korea, other countries are now seeing a bit of a second wave. And as soon as you let everyone move around again, you do run that risk. And we don't even know if people are immune from reinfection. So there's a lot of unknowns still in this picture.
Well, there are. And, the chart there from the guys who've really done some quite good analysis on this shows that there are some good news stories, but we're not testing widely enough. We don't know the full rates of infection. We don't know how many people could well be in the community and still passing it through. And whilst the international infections are way down now because basically everybody's locked down, the community infection is the key question to ask. And it looks as though from what's happening overseas, where there's those spikes like in Singapore, as soon as you take the finger off the lever a little bit and allow a little bit more activity and interaction, then you get another spike. And until we get a vaccine, we are in that risk situation. So people shouldn't think that this is all going to be over in a month. And I'm just amazed at the number of media people now who are saying, oh, come on, we've got to talk about relaxing everything and just getting back to normal. If you do that, you'll be back where you were, and all of the efforts that have been done to date will be for no use. So we need to be very cautious and very careful about essentially, ratcheting the controls off. This is a marathon, not a sprint. This is not just a few weeks, but this is months and months of effort to get to somewhere hopefully good at the end of it. But, people shouldn't expect it will just be switched off tomorrow.
Yeah, and that data may change. We may find out that people do have immunity once they've got infection, and that would be good. We may find out that there's been widespread community transmission with people that were asymptomatic, and that is good as well. And there's talking, I think on the news this morning, some test cases about maybe somewhere South Australia, Tasmania, these places that have got very few cases being the test beds for gradually opening things up in stages. But all this is going to take, any action you perform, you've got a 14 to 28 day lag time. So these aren't going to be quick changes, and people need to be prepared for that.
Yeah, exactly right. And, I'm afraid the media is doing us no good service by essentially, talking it up and saying, come on, get the economy going again. The New South Wales Premier a couple of days ago talked about this could be 18 months until the vaccine, and then was basically accused of being too negative. I think actually it was being quite realistic. So.
We'll keep everyone up to date anyway with that, Martin. Okay, so Next up here, you've got the BIS, a little takeaway here from the spillover, as we just discussed, about the wider implications that can drag on for GDP, for the health issues and the economic issues.
Yeah, so the BIS, the banker's banker, as it were, came out and made the point that until you get this controlled in all countries around the world, you haven't solved it. So even if you manage to control it in a particular geography, as soon as you open up things again, it's going to come back. And that is really the important message. This is going to be a long-term issue that we're going to have to face. And hopefully we can pull the things around and start to get the economy firing again. But you can't just look at it in isolation. You've got to look at it on a global basis. And there are many countries that are really struggling at the moment.
Yeah, and to give people some real world examples about that concept, it's even if Australia was to be really lucky and get back to normal in 6 months, some of our manufacturers, some of the people that import our goods aren't going to be. So that number is never going to get back to where it was unless everyone is back to normal. And even in that stage, we've got friction to restart a business, to rehire staff, and a lot of those people are going to be in more debt and trying to pay that down. So I just don't think that we're going to get back to those levels of growth and the levels of euphoria we saw in terms of investing and whatnot for a very long time.
Well, I think we're probably going to a new normal, and that new normal will, I think, have some different characteristics to it. And typically, when you have a deep downturn, you don't get a V-shaped return. People were talking about a bounce back. It more is like a U-shape, if you're lucky. Hopefully not an L shape, but some people are suggesting that we actually are going to grind through for a long time. So this is a really wicked problem. It's a long-term problem. It's a global problem, and we've never seen anything like it. So we have to expect that we're going to see some very significant and bad issues ahead of it.
Yeah, and just the one thing I would add to that is that doesn't necessarily mean that the stock market won't be doing crazy things and going higher. So we're talking about the real economy and the stock market, and they are two very separate things these days.
Well, the more money you pump in, the more stocks are going to go up, bonds are going to go up. And, the banks, central banks are buying bonds and buying mortgage-backed securities and buying stocks in some countries, like in Japan. They're all supporting the financial system. And so we might see those indicators looking positive. But the real indicators in the economy, the economic activity in the economy, the unemployment or the employment in the economy, they are the things to watch. And unfortunately, I think they're going to continue to drag for a long time.
Next up, household confidence. Probably no surprises here, Martin.
Yeah, so it absolutely crashed. Down lower than it's ever been, sort of 73. That's I was surprised even myself at how quickly it dropped. And not only is the average falling, but if you look on the next slide, you can see that even those affluent segments, the people who are always very robust and very positive about their particular situation, now are very negative, not least because the stock markets have dropped, not least because the superannuation performance has dropped through the floor, not least because deposit rates are very low. And, everybody's now concerned about property prices. So pretty much wherever you look, whoever you talk to, the financial expectations of households have dropped dramatically.
Yeah, and from that chart, Martin, it looks to me like relatively that has been a far, far bigger drop, almost twice as much from the free affluent compared to those that are maybe just getting by. And that tells you that, a health condition, a pandemic doesn't play favorites on your situation, but also at the same time, they are the ones with the assets that have been hit very, very hard. So yeah, I think this is it's affecting everyone really widely, but maybe those people that were getting along okay before this all happened, and we were talking about inequality and whatnot, all of a sudden they've had more of a rude shock than some other people.
No, you're right. And the free affluents don't have mortgages. They have property. They have assets. They have shares. And suddenly, all of those asset classes that look bulletproof aren't looking bulletproof. So they're really reeling. And that's going to have a significant impact later, of course, on ability to spend.
100%. And that the virus does not discriminate. So some more Roy Morgan research here into consumer confidence, and any discrepancies with what you found, Martin?
No, it's going the same way. They had this minor bounce last week, but they're seeing the same significant drop. And we've got to get used to these sort of doing numbers at the moment, because they seem to be pretty much everywhere. And just a correlation with my own research, I think.
And business confidence as well.
Yeah, so this was also, again, Roy Morgan, ANZ, and business confidence absolutely falling through the floor significantly, as well as the research direct to businesses. The ABS also said that a significant number of businesses were now seeing their turnover or cash flow being crushed. Around 47% of businesses have made changes to their structure and workforce. 68%, something like that, of businesses say cash flow is a real issue now. So this is dramatic.
Martin, that's a 10-year chart, so it just cuts off the GFC. Do you know what the numbers were back then?
It wasn't as bad as it is now. I don't know, have the full
Okay.
details, but yeah.
It wasn't okay. That's the main thing. Cool.
Yeah.
So mortgage stress has had a big jump already, and this is a data that sometimes takes a little while to flow through. So you've got some projections there.
Yeah, so mortgage stress jumped. So another 200,000 households over a month, from 32 to 37%. And running it forward, I think we got significantly higher than that, above 40%. And worryingly, the rate of stress is absolutely growing. Now, obviously, this takes account of people who got support from the banks to be able to defer their mortgage repayments. But frankly, if you're suddenly out of work, you don't have enough income coming in. And there are various other supports, childcare and those sorts of things. We're trying to take account of all that. Nevertheless, cash flow for many households has really gone through the floor. So my own expectation is that we're going to see this continuing to drive higher. And if you look at the next slide, it's the young growing families who are really right in the firing line. So 72% of young growing families have now significant cash flow issues, difficulty with their mortgage repayments, and even those who are renting also have significant issues as well. So unfortunately, we're seeing, for example, some of those first-time buyers who bought very recently is now suddenly caught. They have these 95% government-backed loans, and suddenly they're now wondering about, was that sensible? So I'm afraid that it's a very significant story, but it isn't just young growing families. It's right the way across the segments, from affluence, from older households. And in fact, in some cases, some of the older households who were reliant on income from dividends, which might be turned off, and other things, are also feeling it too. So this is a very significant and broad development that we're seeing, and we'll continue to track it every month.
And in terms of the mortgage stress and the freezing of the payments, we've heard a lot of stories. I'm not sure what you've heard, but from the accounts I've got, that the deferring, by the time you add up all the interest and whatnot, people aren't really in a better position. But a lot of people are being knocked back, and we've heard this 50% figure of people that have been told, well, it's no good of us as a bank to pause your mortgage for 6 months if you don't have a job at the end of that period, or we don't think your employment sector. And the mortgage brokers that I've spoken to personally shared with me some of that data, and it was just astonishing. The banks are now telling people not to even think about refinancing people in tourism, people working in retail. That's just crazy.
Yes, so they are being quite selective. So some industry segments are definitely being adversely impacted. And even some of the lenders, mortgage insurers, are basically not saying, we're not going to lend to that particular segment anymore. About half of people who apply for owner occupation are getting some sort of extensions. And of course, as you say, it just rolls it out, still capitalizes. It doesn't actually give them anything. It just moves it out. Right? So it gives them a bit of leeway. Property investors, nowhere near as many are getting the relief. So it's really the proper investor segment that's really going to be a hit, I think, in the short term. And the fact of the matter is that you have to jump through hoops to be able to get it. You have to actually talk to your bank. The bank will ask you lots of questions. In some cases, they haven't been convinced that you've been directly impacted so far by the health issues, and therefore won't make any changes. So you have to demonstrate it. So there is a significant set of processes and procedures. And I think, again, we've got this thing where at a top level it sounds good. When you come to execute it and see how it works in practice, the reality is much less good.
The other stories I've heard, Martin, and I'm not sure if it's coming through in this data anywhere, let me know, but a lot of people that were sub-leasing and renting out properties as Airbnbs, and stories of people, we're going to get to your slides around Melbourne and the suburbs, stories of people that had 10 or 20 Airbnbs that were constantly booked out, making a lot of money. As soon as all those bookings stop, these people are in a lot of trouble, but their landlords are finding out that they didn't have a tenant that was living in their property and paying week to week.
Correct. Yeah, the Airbnb story is going to really develop, I think, quite quickly. We're certainly seeing a lot of people who are ex-Airbnb, property holders now trying to rent those out longer term and getting some rent, but not much rent. A lot of furnished properties suddenly there and available for long-term rental, right? Yeah. So this was a story, people weren't aware of it, I think, as another. And in some cases, the leases under which those were actually being offered out it wasn't legal. They weren't allowed to do it, but they did it anyway. So yes. That's another issue that's now coming to the surface. And suddenly some landlords are finding that what they thought was happening with their property isn't what was happening.
Yeah, that is going to be so interesting to see how that plays out, whether or not these rules around who gets to renegotiate in that circumstance if that changes things as well. I think we're going to have to see government step in at some point about who they choose to bail out. But it's good news for renters, I guess. We'd expect to see rents come down a lot.
Yeah, renters are getting 20-30% discounts. In fact, if you've got a rent at the moment, it's worth asking your landlord for a discount, frankly.
And I was going to say, just in terms of the sort of corporate real estate market as well, I think longer term, this whole working from home, people that have never used Zoom or Slack or Whereby is the one that we use. It's free, guys. I recommend you all try it out. But I think it's going to get people who are set in their ways to say, well, maybe I can work from home one day a week and look after my child and save some money on that daycare or whatnot.
Yeah, as long as the NBN works, it'll be fine.
And we know that was going to be an issue, don't we, Martin?
Indeed.
Next up, you've got some suburbs here in Victoria that are experiencing the most stress.
So I've just listed the top stressed postcodes across the country, and it's interesting, quite a few are in Victoria. And just note those coupled with the little blue arrows there, because we'll come back to that in a second. There are a couple of postcodes who I'm watching very closely because we're now looking at forced sales, and there's a correlation between mortgage stress and forced sales that we're starting to spot.
And for people that can't read that at home, that's Hobbler's Crossing and is that Cannons Creek, Martin?
Yeah, that's right. Both Victorian postcodes. Yeah, watch those two because they're right at the top of the list when it comes to forced sales.
You've got the Geomap here for people at home just to visually see which suburbs are getting worst hit.
Yeah, I just sort of picked up Melbourne, and just to highlight that it's not uniformly spread across the area, but there are a number of suburbs, particularly new suburbs, particularly those with high development, particularly a lot of migration, and quite often a lot of these postcodes have average incomes above normal. So people have been used to relatively high incomes, big mortgages, and suddenly it's all going pear-shaped and quite quickly. So, in fact, if you go to the DFA blog, we've actually published some maps for pretty much every geography, so you can see some of the differences.
For sure. I've zoomed in a bit there for people at home, Martin, but head to the DFA website for all the details there. Sure. Forced sales are rising a little bit, but probably not as much as reflected in some of the stories we're hearing. So that's all sort of got to flow through yet still, doesn't it?
Yeah, so we've been surveying people specifically about their plans to essentially sell their property. Now, when we talk about forced sales, many people just talk about the banks forcing people to sell. That's very low at the moment. There's hardly any evidence of that increasing. But there are people who've decided they want to sell, need to sell. About 8% of property investors are actually thinking they should get out while they can. The rents now don't work. They were ex-Airbnb. It's still pretty expensive to service the property. So they are pushing into the market quite quickly. And in fact, the SQM research there shows that the listings have increased over the last month, which, you'd think it's a bit weird, really. You expect people just to back off at the moment, but no, there are people pushing to try and sell. And there's around 2% of people with owner-occupied properties who are also struggling now with cash flow, with no jobs and those sorts of things. Interestingly, though, when you look at it in more detail, you'll find that some of the older households, so people, for example, we call them the wealthy seniors who have 2 or 3 investment properties, are suddenly finding that they need to sell one of those investment properties because their income is being squashed because of, for example, the fact that term deposit rates are so low and the stock market performance has not been effective. So quite a few of those are now looking to sell, and also some younger people as well, particularly owner-occupied people. So this is something to watch. We'll watch the trends ahead. But this is a very important dimension now that we've started. And again, there are maps on the DFA site showing all the different postcodes and how it works out.
Yeah, as you say, those baby boomers that have watched their super fall 30 or 40% are now thinking, is that rental property a liability? Should I sell that? There's some tax benefits of having a better principal place of residence and just having that capital to maybe they want to push that $800,000 house back into the stock market when they think that there's a bottom near to get some dividend paying shares. So there's a lot of things that are changing there.
Yeah, and particularly if you have an expectation, as most people do, that prices are going to drop. So, people are saying 20, 30%. I think that's probably not unrealistic. So you want to try and get out now if you can and get some of that capital that's on paper, because the longer you hold off, the more the prices will fall and the less value you'll have in the property.
And I should just note that banks are probably going to have to cut their dividends for those people that are looking for dividend-paying shares, Martin.
Yep. We'll touch on that in a second because that's a very important point. And we'll talk a bit about bank accounting and how the banks are accounting for the fact that mortgages are not being repaid but are being repaid. So that's another story.
You've got some more postcodes here for us, Martin, that are topping the forced sales.
So this is forced sales. And again, it's just interesting because you'll see that some of those postcodes that I showed were stressed are also those postcodes with high degrees of forced sale as well. And it's an interesting mix between investment properties and unoccupied properties. Most of it is investment properties, but there are now a few unoccupied properties in some locations now coming into the market too. So again, this is something to watch, I think, in terms of the development of the need to sell, being driven to sell and trying to sell quickly before prices fall too much.
Oh, for sure. Yeah, for people at home, we'd expect that correlation to be extremely high from the mortgage stress turning into a forced sale at some point. Yep. And you've got another heat map there, this time for those forced sales estimates.
Yeah, and the two red colours are those two that I highlighted earlier on, those two high-stress postcodes. They're actually the ones where the highest degree of forced sales are happening. So it correlates, but it doesn't correlate immediately. So you can deal with stress for a time. But, of course, if you don't have an income, and suddenly a job's gone, then that imperative to get rid of the property or change moves very quickly.
No worries. And if Martin will send me the link and I'll put that down below to have a look at those maps. So Next up here, we've got the super. Now, this was something that got a lot of debate happening on Twitter and whatnot. And a lot of people have looked to take this up, Martin. So I read an ABC article that actually said 600,000 people have applied. And if you crunch the numbers, they can take out between $10,000 and $20,000. We're looking between $6 and $12 billion that would be forced sales by super funds. And sure enough, we see Host Plus and I'm sure others of changing the rules so that you're not even allowed to sell to cash, let alone withdraw your own money.
Yeah, so this is a really big issue. So a lot of super funds were actually revaluing unlisted properties and those sorts of things in their funds down. So the value of their funds have dropped, and of course the equities have dropped as well. And now we're getting a lot of requests from some industry groups like this particular one is actually in the hospitality sector, which of course is where a lot of the job losses are. So not surprisingly, a lot of people need to get hold of some of that money, and the government has allowed $10,000 withdrawal. So this is putting a lot of pressure on super funds, and now there's even talk about whether super funds will need a bailout from the government to help with this because of the liquidity. Now my argument is, well, super funds are all about managing risk. They should have been aware of these risks. And yet they were just willy-nilly just investing in things that, in their view, only went one way. Unfortunately, they can go the other way. And the thing to make the point is, even if you pull the money out now, the people who are left are going to be left holding the baby. And so, in fact, the value of their superannuation will drop even more. And in some cases, these funds could go down 20 or 30% or even more. And that's huge for people who thought they had a nest egg for retirement. So the two nest eggs, property and super, are both being dramatically eroded by this. And I don't think this is going to necessarily bounce back quickly, even if the economy does pick up.
No, and this is something that I do want to have a little rant about, because something that I've been predicting would happen, that the Fed would make their way down that food chain, just like we've seen the Bank of Japan do and the ECB. Today, the Fed come out and say, another $2 trillion, we're going to buy up junk bonds and those junk bond ETFs. It was only yesterday I made a video about that shale oil or the energy sector that's in a lot of trouble, and it's going to collapse markets, and that's why they're having to print money and bail them out. And the exact same thing is going to happen in Australia. If everyone tries to withdraw from their super, traders and investors are going to front run this if they know there's $12 billion of forced selling coming. As you said, the people that are left in that fund are going to have a lot less assets, and that's not fair on them. So the RBA are going to print money and they're going to bail out these funds. They're going to end up buying ETFs. And at a time when Phil Lowe's already talking about tapering his QE, I just think they've got no idea what is going to need to be done for them to prevent the Australian markets from collapsing. And no matter what they do, it ends up bailing out the financial markets and those that are already better off and taking a clip from the system, and it doesn't actually help the average guy. Even if your super ends up being okay, you're still, worse off in terms of inequality and, all that stuff that we always talk about on the show. So that's my little rant.
Well, no, you're right, ranting absolutely right. And I go back to, there was a Bank of England executive said some time ago, do you realize that at the end of the day, it's the average householder who's going to pick up one or the other. It's either going to through the tax system, or because the superannuation goes down, or because the property market goes down. There is nobody else. At the end of the day, we are going to pay for this. And that's the problem. And look, my view is that all of these central banks who've been throwing liquidity all over the place have been doing it with a very narrow agenda of financial stability in the financial system. But we've been not consulted. There should have been, I think, more of an understanding of the implications for us of those decisions. And once again, the 1% are being bailed out. The rest of us are being effectively taken to the cleaners. And unfortunately, there isn't much we can do about it.
No, and I think there was a headline today that summed it up perfectly, and it said that financial markets as we know them changed today because the Fed have effectively said we are not going to let prices go down. And so there's always a buyer. It doesn't really matter how many sellers there are. Assets are going to stay levitated. Now, that ends really badly, I think, in inflation eventually because there's trillions of dollars sitting in US dollars at the moment. That's where everyone is flying to. They're going to want to redeploy that capital. That's going to start to circulate around the economy. People are going to get these checks and then they're all going to want to buy their food or whatnot. So I think this is going to end in a lot of inflation.
Well, it's interesting because Jerome Powell was interviewed at the Brookings Institute, in fact, overnight. And he was asked specifically about the risks of inflation. And his view is, no, there's absolutely no risk of inflation. In fact, deflation is going to be the big risk, right? And it's like, yeah, hang on. But, that's a really myopic view. And I'm concerned that there is a scenario with very high inflation. There's also a scenario with deflation and depression. Neither of those look very comfortable. The problem is, of course, that the economic consequences of those two are very different. And in some situations, if in a deflation environment, gold probably goes down, whereas if you actually get inflation, gold goes up, for example. So it actually has a significant impact on other asset classes. So just as nobody knows.
No, and I think we could have both at once. We could even have stagflation where people aren't getting, a raise at their job while food's going up. It's inflationary, and in other areas of the economy, boomers are selling their assets and the economy's slowing down and we're seeing deflation. So the Fed have only got very limited tools. And at the moment, they're focusing all their attention on pushing up financial assets. And it's just madness. They've got no idea what they're doing. They're making this up as they go, and it's not going to end well.
I fear not. And then there's, 380 trillion of debt around the world, some dramatic amount, right? That has to ultimately get paid, I fear.
For sure. Okay, so the RBA, they've come out with their stability report. Again, I think they've got less of an idea and they're trying to copy what the Fed do and whatnot, but they're just not prepared for how rough things are going to get and what they're actually going to need to do.
Yeah, and it's worth, if somebody's interested in what they said, it's worth reading the 70, 80, 90 pages of stuff. But, to boil it back, they're basically saying banks are fine. They've got high amounts of credit capacity. They're going to take higher risks than previously, but they can do that. So they're saying the banking system is absolutely fine, right? And then they say, but households, well, some are going to get caught because essentially we know that a proportion of households, and they're suggesting maybe 20 or 30%, are going to be in significant difficulty. But they also say many others are actually looking pretty good. The trouble is they're using data that's 3 or 4 years old for that analysis. It's not up-to-date data, and we know that there's a higher proportion of households now with deep difficulty in terms of cash flow. So I think they're understating the risks to households and to businesses. They call out the fact that property prices are likely to slide, and they're not saying how far, but they're suggesting there are risks there, and they talk about the risks in commercial property as well. And I think those risks fold back to the banks, and essentially, will the banks be able to deal with this or not? And if you go to the next slide, there again from the stability report, they suggest that the loan-to-value ratios will effectively go the wrong way. So a greater proportion of people will be in negative equity. We know that's always a problem. We know that some people have paid ahead on their mortgages, but a lot of people haven't, and it's those people who have no real capacity. And of course, in the middle of this, the auction clearance rates are dropping dramatically. So the property sector is falling, and the Reserve Bank, even their stability report, is suggesting that prices will drop, mortgage issues will rise, and therefore delinquencies will be higher. And they're trying to then calibrate. But they're always going back to the banks are well capitalized and it's not serious. And even when they ran their stress test previously, everything was fine. I hope they're right, but I'm nervous that they may not be.
Yeah, I don't think their stress tests are planning for what we're going through at the moment. But one thing that I probably have changed my opinion on is that bailout scenario that we've both done a lot of videos about, the negative interest rates and banning cash. And I think the Fed, what they did last week, where they came out and said, we're going to print as much money as you need if you try and withdraw it out. So the whole sort of fractional reserves and deposit limits and whatnot, they're actually going to stuff the system with cash. So I don't think there's any fear of lack of liquidity. That's probably good for people that were worried about their gold being bailed in or deposits being bailed in. But again, longer term, it has all those repercussions that we already discussed.
Well, there's a very interesting comment in the financial stability. They talked specifically about the fact there had been very significant cash withdrawals towards the end of March, $100,000 or millions of dollars. So people were going in and dragging cash out, right? Because they wanted just to keep hold of it. But then they said, that wasn't an issue. We just moved the cash around and have facilitated that. So you're right. I don't think that deposit bail-in is now high risk at all. I think, in fact, the banking system from a deposit perspective looks looking a lot more secure than it was 3 or 4 weeks ago, right? They will probably bail in some hybrids, but that's okay. That was always designed to be there. So I think the broader bail-in agenda is off. And that means that we can be a little bit more confident that the deposits that we hold in the banking system will still be there when we need them, which is good.
Yes, absolutely. Next up, we've got a bit of a warning from APRA, Martin.
Yeah, so APRA wrote to all the banks and said, look, do not necessarily pay dividends because of the current situation. Be very cautious and careful, do some modeling. And if you're going to pay dividends, pay less, and don't buy back shares and things. So they're trying to get the banks to keep the capital in the system rather than pay it out. And the Bank of Queensland, who was the first bank who made announcements this week, basically said, we won't be paying a dividend at the moment. We'll review it, but we're not paying a dividend. So expect bank dividends to be much lower than people expected. The other thing that is interesting is the banks are essentially still able to book those mortgage repayments that haven't been made. So when you're actually given a 6-month holiday, that is still booked in the banks. So effectively, the banks can still show that as profit in the next half year, right, despite the fact that people haven't paid them. And whilst they have to put some bad and doubtful debt provisions in place, APRA's allowed them latitude with regard to these repayment holidays. So just because people haven't made those mortgage repayments, they're not actually regarded as default loans. So APRA is making it as easy as possible for the banks to dress their balance sheet as positively as possible. All right. I just worry about that because, again, disclosure. And talking about disclosure, if you go to the next slide, this is from the US. And there was a paper published by one of the feds who basically said, look, it'd be rather good if we stop publishing information about banks' balance sheets at the moment, because if you publish bank balance sheet balance information, there's a risk that some corporates will pull deposits out of banks. And they quoted examples back in the 1930s of banks where that happened. So there's actually a plea and a request in the US for less transparency about the banking system. And I find that remarkable. Put the last 2 slides together. So APRA is basically saying, yeah, you can fudge your figures, banks, no problem, just don't pay dividends. And the Fed's saying, well, we won't disclose information about individual banks' balance sheets necessarily, because that might actually lead to a run on the banks. And they're not worried about retail deposits because they're guaranteed, but it's corporate deposits, the millions and millions of dollars held by corporates in the banking system. So this just goes to show you again some of the unintended consequences of what we're seeing at the moment.
And people that don't watch our show or do the scouring of these announcements are not going to be aware of all this. So you're going to see banks on the news saying, our balance sheets are strong, we're still making plenty of money, we're going to keep paying dividends, or we're going to pay a small dividend, whatever it is, where other countries have just made them illegal, as well as bonuses in some countries. But they're not going to be telling you that no one's actually paying their mortgage, even though they're reporting that as profit. And just like Apple stopped reporting their sales numbers when things started to get bad, now banks are going to stop reporting their balance sheets because things are going to get bad.
Yeah, and APRA basically has given them latitude. Also, ASIC has basically said to banks, and if you want to make interest-only loans rather than principal interest loans and convert them across, that's fine. You can do that now, and you're not breaking any responsible lending laws. And going back, a year ago, everyone was trying to get people off interest-only loans to principal interest loans because of the risks. And now, effectively, the regulator said, no, fine, you can switch them back if you want. So, this is another classic example of, regulatory environments that aren't actually helping anybody, in my view.
Yeah, it's kind of like herd some more sheep in because we need to try and keep this bubble going for a little while.
Just get people to pay anything they can. You just keep paying the interest, take more loans, feel free. Take more debt. That'll be fine. At some point, this debt story has got to come to an end.
Yes, and I think we're in the last few chapters, Martin, and you've got your outlook here for the next 24, 36 months.
Yeah, so I just updated my scenarios. And essentially, look, there's a 6% probability, I think, of property prices dropping between 30 and 45% over the next couple of years as all this plays out. There are other scenarios that you could explore, but that's now my central case. My expectation is that we're going to see mortgage stress above 40%. We're going to see unemployment in the ABS numbers more than 10%. And we're going to see bank losses continuing to rise. But I also have the view that now, with everything that's been going on, the banks are going to be fine because the government's going to support them. The Reserve Bank's going to support them. So the banking system will be fine. But what about the real economy? And what about real people? And that's the thing that I just get so frustrated about.
Yeah, and I kind of agree with the first few columns here of that scenario, but I don't know if I agree with the house prices part, because we might see unemployment that high and mortgage stress that high, but they start printing money, buying mortgage-backed securities, pushing up all these asset prices. The rich have got so much money now and interest rates are so low, banks are begging people to take out loans. So the wealthy that have got 10 properties decide that they're going to buy 20 and house prices go up even though everyone's losing their jobs and not got any money. So it's just this upside down world we live in that favours the wealthy, and hopefully more people take the time to learn about what's going on and we can all gradually bring about change.
Well, let me just give a shout out. Michael Hudson, economist, I did an interview with him on my channel about 3 weeks ago, and he was talking precisely about what's going on, which is essentially the 1% gets more and more of the financial help in this crisis, and they benefit, and all of their assets go up, and everything. But the rest of the people, the people who are having to pay rent either through mortgages or other things, they are the people who are getting messed over. And I think that's really the big thematic that I want to leave today. This is a very unjust correction that's going on at the moment. All of the focus is on protecting the banking system and the 1%, not about real people. And I really believe passionately that we've got to change our way of thinking if we're actually going to get out of this, into a future that we actually want to get into, rather than one where effectively the assets are owned by a smaller proportion of the very wealthy and everybody else is just struggling and the middle class gets crushed out of existence.
Yeah, and the natural business cycle was playing out nicely for hundreds or thousands of years, and civilization progressed just fine with a business cycle, Martin. But we're not allowed to let businesses fail or share prices go down these days, apparently.
No, well, basically, there's the old adage of you privatize profits, but you socialize losses. And that is precisely what's happening. But at the end of the day, those losses are picked up by you and me and other taxpayers around the world to support a banking system which is not right, it's not fit for purpose, whilst the 1% continues to make profits and enjoy a lifestyle which is unheard of elsewhere. It's not fair.
100%. Well, guys, there's so much going on at the moment. Make sure you follow us on Facebook and Twitter for daily updates. You can join my Facebook group. Make sure you're reading Martin's website and following all his videos on his channel. And Martin, we'll talk again soon.
Yeah, plenty to talk next time, I'm sure. Cool. Take care.
Thanks, guys.